welcome to the Daily Consolidation, your 15-minute briefing on today's market action. We break down the day's most important moves on Wall Street, delivered right after the closing bell. Please note, this is an AI-generated podcast, and the views shared here are for educational and informational purposes only. Nothing we discuss should be considered personalized financial advice. Always do your own research and consult with a qualified financial professional before making any investment decisions. Now let's dive in. Thursday, November 14th, felt less like trading and more like an emergency room visit. If you looked away, you missed a 1.5% swing in either direction.
It was incredibly volatile.
We truly saw a tale of two sessions today, characterized by these violent intraday swings, especially after that steep morning sell-off.
Right.
So the big question we need to answer is whether that impressive afternoon recovery signaled underlying strength or, more worryingly, just masked some far deeper instability.
I am leaning heavily toward the latter. The closing numbers are deeply deceptive. The S&P 500 managed to close down only 0.05% at 6734.11, which sounds like nothing.
A flat day, basically.
Exactly, until you remember it had plummeted 1.4% at its intraday low.
That's a huge shift. I mean, that's the kind of volatility that forces hedge funds to manually shut down their automated trading systems.
And the Nasdaq was even more dramatic. It managed to claw its way into the green, closing up 0.13%, despite trading down almost 1.9% earlier in the day.
But the Dow couldn't quite stick the landing.
No, the Dow Jones still finished down 0.65%. But the real evidence that this recovery is brittle, a technical artifact, if you will, is the VIX.
The fear gauge.
Right. The volatility index jumped 14.22% on the day. It closed right at that psychologically important 20.00 level.
And when the gauge measuring fear spikes that much, it tells you the index recovery is fragile, doesn't it? It suggests a lot of underlying stress.
Precisely. That fragility is accelerating what we're calling a regime shift this November, a sharp transition away from that comfortable complacency we saw back in October.
And we've identified three critical pillars driving this new elevated volatility, with each one sort of feeding into the others.
And they all point toward a fundamental reassessment of risk across every major asset class. The first pillar is what we're calling the cryptocurrency capitulation.
Okay.
Bitcoin plunged below $96,000 today. Now, to put that in perspective, that's down over 23% from its $126,000 peak just last month.
And this isn't just retail angst, is it? We're seeing institutional flight.
We are. We tracked $870 million in U.S. spot Bitcoin ETF outflow in a single day. It's one of the largest on record.
So the regulated smart money vehicles that were supposed to legitimize crypto,
Yeah.
they're now the exit ramps.
That appears to be the case. And if you want the emotional context, the crypto fear and greed index collapsed to 22, which places it squarely in extreme fear territory. The money that poured in is now rushing out.
The question is, why are these huge institutional players rushing for the exits? And that takes us to pillar two, which is the credit market repricing.
Yes, moving out of digital assets and into the fundamental plumbing of the financial system.
So when we talk about credit spreads jumping, what does that actually mean in plain English for the everyday business environment?
Think of credit spreads as the price of corporate insurance. It's the extra interest or risk premium investors demand to lend money to a company instead of lending it to the super stable U.S. government.
And that premium is skyrocketing.
With incredible velocity. I mean, how fast are we talking? Investment-grade corporate spreads rapidly moved from 75 basis points.
Which is incredibly tight, indicating high confidence, right?
Exactly. Back in late October, now they're at approximately 120 basis points today.
So a 60% increase in that risk premium in just 2 weeks.
Yes. And if that wasn't enough of a warning sign, look at the high yield, the junk bond market. Spreads there ballooned from 280 basis points to 461. That signals a sharp deterioration in risk appetite.
And credit investors are usually the first to spot trouble.
They're typically the first, and right now they're screaming.
And when credit investors panic, it's usually because they've stopped believing the Federal Reserve will necessarily step in and bail the system out, which naturally brings us to pillar three, Fed policy paralysis.
It's a huge shift. The market had nearly 99% certainty just weeks ago that we would see a December rate cut.
And now?
Now, that probability is a coin flip, 50%. The market has absolutely capitulated on the idea of guaranteed easing.
The hawkish commentary has been relentless. Boston Fed President Susan Collins cemented that narrative today, stating that it will likely be appropriate to keep policy rates at the current level for some time.
And you have to remember the context. Inflation is still running near 3%.
Well above the 2% target, and it has been for over 4 years.
Combine that with the data black hole created by the recent 43-day government shutdown, and, well, the Fed is operating without a clear line of sight.
That makes them cautious, which in turn makes the entire market nervous.
And that cocktail of crypto turmoil, surging credit stress, and Fed paralysis, it's leading to some truly unusual action in equities. Traditional portfolio rules just seem to be fracturing.
Breaking down in real time.
They are. Cross-asset correlations are all over the map. Today, we saw gold and treasuries rally, a classic flight-to-safety move, which you'd expect.
Right.
But equities also recovered dramatically from their morning lows. That breaks the typical inverse relationship where risk assets fall when safe havens rise.
But I'm a little confused here. Gold usually gets crushed when the dollar rises. That's a textbook relationship. What broke that today?
A great question. The dollar had a modest 0.13% gain, yet gold still surged 1.24% to over $4,000. That violation suggests the safe haven demand in gold is just genuine. It's intense, and it's overwhelming the usual currency effect.
And the kind of weird simultaneous movement makes portfolio hedging extremely difficult.
Very difficult. And when we look at equities specifically, the divergence between the Nasdaq's positive close and the Dow's 310-point drop tells you exactly what kind of market leadership we have.
Narrow and concentrated.
Exactly. Technology bounced aggressively, while the defensive, slow and steady sectors that led earlier in the week actually pulled back today.
And consumer discretionary is the clear laggard right now. It's down over 3% for November, on pace to snap an impressive 6-month win streak.
Disney was the poster child for that today, wasn't it? Plunging 7.8% on a revenue miss.
It was. Meanwhile, the clear leader continues to be healthcare, which is up 5.9% for the month. That signals that institutional investors are rotating towards sectors with quality earnings and, proven recession resilience.
But even within that aggressive bounce we saw in the afternoon, there is persistent evidence of internal weakness.
Okay, what are you seeing there?
Well, despite the S&P 500 closing flat, the internal market breadth is exceptionally poor. The Nasdaq recorded 230 new 52-week lows against just 56 new highs.
So let's translate that. That's a brutal 4-to-1 ratio of losers to winners. It tells you the index is being held up by a few champions, maybe the big tech names, while the rest of the team is collapsing.
The overall scoreboard looks okay, but the team's health is terrible.
And that fragility ties directly back to AI valuation concerns, doesn't it?
It does. The tech recovery today was tactical, not really based on conviction. We've seen Palantir and Oracle slump roughly 15% over the past 2 weeks, despite what many consider solid fundamentals.
Which indicates investors are questioning whether those massive AI capital expenditures can be justified if the Fed keeps rates higher for longer.
Squeezing profit margins. Exactly.
Now, moving to fixed income, the Treasury market looks surprisingly quiet today, which seems impossible given the chaos everywhere else.
It does, but Treasury yields were subdued. The 10-year yield was down just 1 basis point to 4.12%.
Which reflects that safe haven demand we were talking about.
Right. Investors buying the stability of government bonds, offsetting those inflation concerns. But as we discussed earlier, the quiet front on yields hides the true story of credit risk.
The spread widening.
Yes. The fact that investment-grade spreads are at 120 basis points and high yield is at 461. That rapid widening is the truly significant signal for forward-looking risk.
Shifting to commodities, we're seeing the return of the geopolitical premium in energy, which seems to clash pretty sharply with the bearish fundamentals.
It does. WTI crude climbed to $59.42 after Iran seized an oil tanker in the Strait of Hormuz, and Russia's Black Sea port had some export halts.
So geopolitical risk is back on the table.
It's back, despite the EIA projecting a global oversupply and Brent averaging just $52 a barrel next year. It's the war premium fighting economic reality.
And that tension is driving natural gas, too.
Natural gas is having a remarkable run. It's up 52.68% over the past month.
Wow.
That's driven by forecasts of cold weather and huge LNG export capacity additions. Meanwhile, gold rebounded 1.24% to over $4,026, defying that rising dollar.
which again indicates genuine, renewed safe haven demand is coming back into the metals market.
After that steep crash in October, yes.
Let's talk about real estate, where we have a bit of a paradox. Mortgage rates have seen some relief. The 30-year fixed rate is holding steady at 6.24%, yet the residential market is stagnant. Why isn't that translating into activity?
It's what's called the rate lock-in effect. Homeowners who secured mortgages, sub 4% during the pandemic, simply refused to sell and take on 6+% financing.
So the housing market is essentially on strike.
In a way, yes. The data confirms this. Pending home sales fell 0.3% year over year, the first decline in 4 months. And properties are taking 49 days to sell.
Which is the longest since 2019 for this time of year.
Right. So the lack of inventory caused by these locked-in homeowners, combined with a median home price still at $440,000. Well, even lower rates can't fix the underlying supply problem.
So buying a house still consumes nearly half the median household income.
Precisely. It's a supply-side crunch layered right on top of a persistent affordability crisis.
As we look ahead, next week is going to be crucial. That 43-day government shutdown created a massive backlog, and now we're facing a data deluge.
A huge amount of event risk. The delayed reports are pouring out. We have August construction spending, factory orders, international trade. But the most critical release is the delayed September jobs report. That's on Thursday, November 20th.
So we're getting 2 months of employment data dumped on the market at once.
Effectively, yes. That could confirm severe labor market deterioration or, resilience all at once.
And the single biggest stock catalyst will be NVIDIA earnings.
Tuesday, November 19th. This report is a critical test for the entire AI thesis and, by extension, the direction of the Nasdaq.
The market needs validation.
It desperately needs validation that massive capital expenditures are translating into sustainable revenue growth. If NVIDIA disappoints, that fragile recovery we saw today could vanish very quickly.
So given all this incoming event risk, what are the key technical levels we should be watching?
For the S&P 500, we need to watch key support at 6,700 and then the 50-day moving average near 6,650. If we lose that 50-day, we could be in for a serious correction.
And on the crypto side,
analysts identify $98,000 as Bitcoin's bull market invalidation level.
what does invalidation level mean in practical terms?
It's the line in the sand. Since we closed just 3% below that today, a sustained break means the entire bullish argument for Bitcoin could collapse. It might trigger cascades toward 90,000.
It's the point where technical traders flip from buying the dip to selling the rally.
That's a good way to put it.
So, with all these competing narratives, solid corporate earnings versus rising credit stress and Fed uncertainty, what's the most likely path forward?
The base case remains market oscillation. We expect the S&P 500 to trade within a wide range, maybe 6,600 to 6,850.
Just bounce it around.
Exactly. Competing narratives will keep volatility high, and the real catalyst for the next sustained move likely won't arrive until the December FOMC meeting, where the market is pricing that 50-50 chance of a rate cut.
So the most striking observation of the day, then, is that the S&P 500's seemingly impressive recovery. It's actually an increasingly desperate pattern.
It is. It defines a market trapped between necessary algorithmic buying support on one side and fundamental uncertainty driven by rising credit stress and hawkish Fed signaling on the other.
That's all for today's episode of the Daily Consolidation. For more daily market analysis, subscribe, and we'll see you at the next close.